Call the meeting to order and thank everyone for their attendance. It's always great to have the school board and the city council representing the greatest city of the world together. And we always look forward to the 5-year forecast, I know, with a lot of enthusiasm. And we do look forward to it. It is always very insightful, and it does give us some direction to show that we are planning ahead, which is absolutely critical for us to continue to be successful. So that being said, I will turn this over to the superintendent and the city manager to make the proper introductions, if you'd be so kind.
Well, Mayor, thank you, and members of the school board, members of council. I've lost track of how many years we've done this forecast, but however many it is, I only remember 1 year where it was positive. And it really outlines, I think, the challenge ahead for all of us in terms of trying to deal with a slow-growing economy and yet demand for services that are outstripping that growth. So we do have a structural imbalance that we're highlighting in this forecast, and we do appreciate your interest in this. We were in New York last week talking to the rating agencies, and they very much respect and admire, I think, the process of looking out 5 years into the future with this forecast, and are confident that you all will be able to deal with this as we go into the budget next spring. So I think with that, unless Aaron, if you have comments, Catherine and Farrell are going to actually make the presentation.
Very good. Aaron, you have anything?
We'll turn it over to them.
Farrell, Catherine, we welcome you.
Thank you, Mayor Sessoms. Good afternoon, everybody. It seems like we just did this yesterday. That's how fast this past year has gone by. Today, we'd like to go over our local economy and the performance, what that means in the revenue shared by the city and the schools, where our current expenditure trends are taking our finances, and look at the various projects under consideration and how they might be financed in the future. I will cover the economy. Catherine will take the revenues and expenditures and the projects discussion and wrap it up with some final thoughts. I want to point out that we've provided each of you with a full 70-page paper document that includes a good bit more information and details than we can cover in this presentation. This forecast is different than previous versions in that we will focus on the city's general fund and the school's operating fund. Other funds, such as the school grants or internal funds like the cafeteria, are not really where we have concerns for financial sustainability. Funds such as the city's enterprise funds, which includes the water, sewer, or parking, they are fully supported by the revenue streams for their programs. Other funds, such as the grants funds, rely on the school's operating fund and the city's general fund to provide their required match. We hope by focusing on the general fund and the school operating fund, we can highlight specific sustainability concerns. I want to spend the next few minutes highlighting not just the economic drivers of our economy, but also some of the underlying trends that may cause long-term concerns. The U.S. Participation rate is the rate working adults are either in the labor market or are looking for work. While some of our decline is related to the rise in unemployment during the recent recession and the fact that some of these folks have given up looking for work, the regional economists pointed to a larger trend of decline. Labor participation peaked back in 1999. Since that time, there's been a general decline in the rate as baby boomers retire in greater numbers. The Bureau of Labor Statistics projects that the next 10 years will bring about an aging labor force. Those that are working will be more diverse. And the other overarching trend the economists at the regional forum brought up is that the rate of household formation has slowed. A recent Census Bureau survey showed that the U.S. added 476 households in the 12 months ending March of 14, compared with the previous two periods where household formation averaged 1.3 million each year. If this trend continues, housing, which is our single largest revenue source, may be impacted. This graph shows the quarter-to-quarter change in the nation's gross domestic product. The GDP measures the economic activity of a nation and a region. The graph clearly illustrates the recent recession and the country's slow recovery. The yellow bars are the Congressional Budget Office's projection of annual GDP growth over the next 5 years. They expect 2014 to end at a 1.5% growth for the year, and the next several years to grow at 3.5% before growing more slowly in the last couple of years. The Consumer Price Index is projected by the Congressional Budget Office to remain below 2.5% over the next 5 years, as indicated by the dashed lines. Gas prices, which have decreased recently, are keeping the CPI currently below 2%, and may bode well for consumer spending. Of special note to Virginians is that the failure to pass the Federal Marketplace Fairness Act will result in an increase in statewide gas tax to support the General Assembly's transportation plan. Note that the gas tax will increase 45% statewide. For Hampton Roads, that means it increases from 5.6% per wholesale gallon to 7.6%. There's a 2.1% surcharge in Hampton Roads. Consumer confidence continues to improve, finally hovering around the 90% level on the Consumer Confidence Index, which indicates a more stable economy and perhaps bodes well for holiday shoppers. This graph illustrates that the military spending in the region has seen steady increases and has cushioned the region through recessions. Beginning in 2012, the amount of military spending, both direct and contractual, leveled off as DoD spending was cut as a part of the federal budget reductions. It is anticipated that the DoD funding will remain level through 2014. However, further reductions are possible due to the second round of sequestration cuts in 2016. This graph measures the unemployment of Virginia Beach residents regardless of where they work. As can be seen, employment only slightly below its 2008 peak. Of concern is that even though employment is improving, the total number of civilian jobs in the region is 27,000 less than before the recession. In contrast to the employment rate, the local unemployment rate is at 5.5% has remained below both the state and the federal rate. This graph may be a bit confusing, but what it's trying to illustrate is that high-wage jobs in the city are declining, while lower-wage jobs are increasing. It is looking at the 10-year employment change in industry categories with more than 100 employees. From 2004 to 2013, Virginia Beach has experienced decline in those employed in 2 of the 3 categories with the highest wages. Similarly, all of the 3 sectors with the lowest wage experienced growth over the same 10-year period. While employment is important throughout all sectors in terms of having a more diverse economy, it is important to focus on growing higher wage sectors to generate a higher standard of living for all of our residents. This graph illustrates private sector weekly wages. It excludes government workers. As can be seen, the average weekly wage for workers in Virginia Beach and the state exceed the pre-recession levels. Wages are expected to continue to increase throughout, although roughly at the rate of inflation. This is an annual change in disposable personal income for the United States, shown in the blue bars, and for Virginia, the red line. Annual disposable income, defined as household income after taxes, has seen yearly increases except in 2009 during the worst of the recession. 2013 is the most recent year this data is available, showed just under a 1% increase in disposable personal income for Virginia and 1.56% growth for the United States. Financial experts suggest that monthly housing costs should not exceed 30% of gross household income. Renters in the city spend over 53% of their income on housing costs. This includes the direct rent plus utilities. Homeowners, on the other hand, spend just over 41% of their household income. With the average monthly rent for a two-bedroom apartment being $1,107, it would take an annual income of just over $44,000 or an hourly wage of $21.15 for rent to be under 30%. Virginia Beach residents relying on food stamps or supplemental nutrition assistance dramatically increased during the recession. This growth is attributable to changes made in the eligibility to address the impacts of the recession, as well as the down economy and unemployment. This expansion began early in 2009 and continued through the fall of 2013. Since October of 2013 through September of 2014, there has been a slight decrease in the number in this program. And anecdotally, for the schools, those number of students that qualify for free and reduced breakfast and lunches, in a 10-year period ending in 2013, it went from a 26% of our population to 39%. So, and at this time, I'll turn it over to Catherine for the revenues and expenditures impacts from some of these local trends.
Thank you, Harold. Catherine, we welcome you.
Thank you, sir. One thing I want to highlight is the change in real estate assessments. This is our single largest revenue source for the city and school systems. You can see the run-up for the housing bubble going into 2005, 6, 7, 8. You can see the impact of the recession clearly in these years. 2015 is the first year that we've had positive real estate appreciation in both the commercial and the housing market. And in discussions with Mr. Bannigan, we expect that to continue into the future at roughly 2.5% on average. I think one point I would make in terms of our revenue growth and our ability to sustain the services we currently offer, we need more in this historic level to be able to just not be talking about deficits every year. We need a growth of about 4%, and as you can see, we're not going to see that in the near future. One thing I want to do with this graph is kind of highlight what you're going to see in all the revenue graphs. Every graph that talks about a revenue source will have a red line. That's the budget estimate for each of those years. You can see for the real estate, it's been up and down, partly due to some rate changes that we have. Between 12 and 13, the council approved a 6-cent rate increase, 2 cents for transportation, 4 cents for schools outside the formula. And then from 13 to 14, it went down again to offset the increase in the solid waste fee. All of the revenue graphs will include a blue line, which is the actual revenue collection for the general fund for that revenue stream. You can see by this graph that we're pretty good with real estate. Houses don't generally move, and so we're fairly accurate in those estimates. That's not always the case. As you look at some of these other revenues, you'll see there'll be gaps between what we estimated and what we collected. Sometimes we collect more, sometimes we estimated too high. But overall, we're very proud of the fact that for general fund revenues, we are within a 1% to 2% of our estimate every year, and that's well within our industry standards. So we're very proud of that going forward. So as you can see, Based on that 2.5% assessment growth, we're expecting about a 2.5% increase in the revenue stream each year. Delinquencies are fairly stable. Even through the recession, we didn't see a real jump in that. The gold line will always be the projected values going forward. So you can see that we do project some increase. Just because generally people want to know, each 1% change in the rate for the general funds portion of the real estate tax rate is 4.85. The overall tax rate, because there is a lot of dedications, every 1% change generates $5.1 million. So that's the difference between what gets dedicated out. Personal property tax, this is our second largest revenue stream. This has a lot more volatility for us. If you think about it, what we're projecting today for next July is based on what we collected back in June, and we don't even know what we're going to collect in 15 because that doesn't come in until next June. So that's a variable. We've missed it. I think we told you last year during the forecast and also during the budget process that we knew we were going to miss personal property tax. But it ended up being about $10 million. The good news, other revenue streams were able to offset that. It was mostly in business personal property that we had the error. Hopefully we're working on a process to improve that situation going forward. The other issue that's happening in 15, council approved a 30-cent rate increase for dedication to help some public safety backlog projects that we have out there. In 15, because that revenue starts in January, so coming up in January, there'll be an increase in the personal property tax. It generates $4 million for 6 months. Of the growth from 15 to 16 is $6 million. $4 million of that growth is related to annualizing the tax increase that's going to happen in January. So there's really not that much growth in that revenue stream. It's really the tax rate that's generating the additional revenue. Business, professional, and occupancy licenses, or BPOL. This tax is collected based on a business's gross receipts. The jump in FY15's budget estimate is due to a record number of sales being posted from big box retailers and car dealers. Again, we didn't have a lot of data at the point we made that estimate. It does not look like we're going to make it, but luckily not nearly off by $10 million, more like in the $2 million range. But we have a lot of months before we can make that final call. So 16 and beyond is expected to grow by about 2.3%. Virginia Telecom, this is my one kick at the state every year. Back in 2007, the state eliminated local telecommunications taxes and took it over on a statewide basis. At that time, they promised localities revenue neutrality. Every year since, we have lost money. This has been on a trajectory of decline. We had thought we had seen the bottom in 2014. We had a huge number of exonerations by the state, which dropped us by about $1 million under estimate for that year. So going into 16, we're projecting it to go down again, and then hopefully that will be the bottom and we'll level out in the years going forward. General sales tax revenue, like the state, we'd assumed, and I think I mentioned last year, that there would be a bump in 14 and again in 15 due to the Amazon distribution building being built in the state. The state estimated they'd collect an additional $24 million just from that facility. Our percent, based on our past collections, was about 5.5%, or about $1.3 million. Neither they nor us are getting that revenue. Seems that some of us had figured out a workaround to have shipments made outside the state to us, and we avoid paying the taxes that way. So we're not sure whether that's going to level out. Obviously, Farrell mentioned the Marketplace Fairness Act, which would bring a level playing field in terms of sales tax to brick and mortar buildings and internet sales. That's something I think the state would like to see passed, and I think for the country, I think that's going to be something that's going to be necessary as we try to help our mom and pop local businesses survive. 2016, we're assuming no growth in this tax, but after that point, about a 3% increase. State share sales tax. This is also based on kind of a 1% collection within the city. It then goes to the state Department of Education. They run it through a formula and it comes back. The growth patterns have never matched. I would have thought they would. But I think the formula factors in student enrollment and some other things and causes a change in the growth pattern between this and the general sales. As you can see, the budget to actual can vary quite a bit. And then we're expecting an increase of $2.5 million going into 16 based on the biennial budget the state passed, which they now cannot sustain, so that number may change again. Going forward, it does have a small growth. Hotel tax revenue, I think I need to point out that this is only the general fund portion. As Farrell mentioned, we changed the format of the forecast a little bit to focus on the general fund and the school operating fund. This is actually a $25 million revenue stream, but all but about $6 million is distributed out to other funds. You can see that the revenue in total is projected to increase by about 5% over the forecast. And the good news is the revenue per room night is up. We've had a really good tourist season for the last couple of years, and I think all indications are that that's expected to continue. Restaurant meals, that has been our saving grace through the recession. All of us like to go out and eat a lot. Again, like the hotel tax, this is actually a $60 million revenue stream. All but about $37 million is transferred out to other funds to support those programs such as TIP Open Space or the Tourism Advertising Program. This is expected to also increase over the forecast year, but by slower rates. State revenue for the city, this is the state revenue for the general fund. Majority of this is human services revenue. When you see that we miss budget here and here, human services revenue is on a reimbursement basis, so if they don't expend it, they don't get it. So if they have a lot of vacancies, they don't get the revenue to back them, and therefore they don't make the expense either. So the good news is that kind of balances out over the operating budget. FY15, we already know that the state, to address its own revenue shortfall, has lowered basic aid to the city. When the forecast was put together last week, we thought we were going to be hit for $1.3 million. The letter came in today, it was $1.5 million. Obviously, that's not a big bump in our overall general fund revenue stream. We'll monitor that and all the other revenues to make sure we stay on track to make budget. By the way, that cut also carries over into 16's budget process as well. State revenue for the school system. Unlike the city, the school's being held harmless this year for any reductions in K-12 funding from the state. But what I'm hearing from folks who deal with the General Assembly is don't count on that going into 16, that they anticipate some reductions there. I mentioned the 4-cent increase in the real estate tax that's given to the schools outside the formula. That was the City Council's attempt to try to address some of the lost state revenue through the recession. Schools lost about $60 million through that period. That 4 cents generates about $20 million. That tax rate is tied to the state getting back to a $350 million level, and I'm not sure that we're going to see that in the near future. Federal Revenue City, again, a lot of this is in the human services area or the housing department. It's not a big revenue stream for the city. Again, as revenue drops, generally expenditures are also dropping to offset it. We've leveled this out for the forecast period, again, in anticipation of some kind of federal sequestration impact on this revenue stream. Schools federal revenue, it's all over the place. I think the big thing for the forecast period is there's an assumption that we will lose $4 million of the $16 million revenue stream due to the Department of Education not receiving sufficient funding to fund basic federal impact aid for military students in the system. Hopefully, they'll be able to straighten that out. They have sometimes in the past been able to find the money to make that work. But so we assume a $4 million drop from 15 to 16 and then level funding through the forecast period. I want to spend a little time talking about use of fund balance for the city and school system. This is a major change in the assumptions from previous forecasts. This is the city's use of general fund balance. You can see during the recession, We use some to help us and the school system get through that. As a general rule, it all goes into the capital improvement program. If we're going to use fund balance, we put it towards one-time things, so we're not building a reliance on that fund balance use. What you can see is as we used it to get through the recession, we decreased the amount that was going into the CIP, causing our CIP to rely more on debt, and ultimately the debt service came back to hit the operating budget on the backside. As we came out of the recession, the city started making a commitment to try to ramp this back up more towards its $25 million level. What we're proposing, this is related to the loss of the SIPSA contract, the Southeastern Public Service Authority contract. For the city in 2016, January of 2016, we're going to lose our capped rate. So what we pay per tonnage right now is $56 a ton. We'll start paying in January of 2016, $125 a ton. That's an estimated increase of about $4 million. And about $8 million in 2017. The other thing that's going to happen as a result of that contract change is they reimburse us for the cost of operating our landfill because it operates as a regional landfill. That's about a $2.3 million loss in revenue to support that the general fund's going to have, or the solid waste fund's going to have to pick up. We've talked in the past, we could, because this is an enterprise fund operation, adjust the solid waste fee. But because it's really kind of a short-term issue, once the market levels out, we have some agreement regionally after SIPSA, whatever that would look like. We're thinking that we just have this short-term blip and then the fee will kind of be able to handle it. We're proposing that you take this out of fund balance. Now again, just as in the past, we lowered the fund balance estimate for the CIP going forward if we make that decision. That's something we'll bring forward for consideration with the operating budget. On the school side, I called it fund balance. Farrell calls it reversion. Basically, kind of the same thing. Schools by state law cannot maintain a fund balance. Any end-of-the-year money, excess revenue, underspending, comes back to the city's general fund. By council policy, we've always appropriated it to a school reversion fund. The change in this forecast is in the past, Farrell and I have assumed into the future some use of reversion funds. And what we want to do is highlight an issue that I have a very big concern about, and I know Farrell does too, in terms of the structural soundness of the school's financial situation. Relying on one-time money is kind of like using your savings account to pay your mortgage. Eventually that's going to catch you unless you can figure out a way to contribute back to your savings account each year. So if the schools decided, and this does not preclude the school board from deciding to do that, there's $12 million of reversion funds in the bank from last year's operating budget that you could bring to bear to your deficit situation. Plus, in the past, you've made a decision to bring back some of the Sandbridge surplus money into your operating budget. Those are still decisions that are out there for the school board. I just wanted to make sure that we were all clear that there is a structural problem, I think, in the school board's funding. So looking at revenue, the first purple bar is the 15 budget, and you see the projection of revenues out. You see this drop here is really related to state and federal funding issues that are out there. Local revenues overall are expected to increase over the forecast period, but at a very slow pace, roughly about 2%, kind of tied into where we think the economy is going to go that Farrell went over. So if revenues are growing by 2%, what are expenditures doing? One thing to remember as we review these expenditures is a key assumption that there is no pay raise in this forecast. We assume that we will, by mandate, cover the 1% that's required by VRS. By practice, both the council and the school board have added a little bit to cover the tax impact to the employees of that. But think of that as a pay raise that employees give themselves. They have to pay 1% more of their salary to VRS, and they get a 1% increase in pay, and so they kind of give themselves their own pay raise. The other assumption that's been embedded in the expenditures is that inflation is only minimally covered. For the school's forecast, there's really no assumption of inflation to the operating accounts. For the city's forecast, it's only 1.5%. So there's an assumption in the forecast itself that city and school systems are going to have to tighten the belt for another 5 years just to make ends meet. So one thing, this is the general fund. For 2015, it's a $1,012 million fund. But I think a key piece of that is that about $433 million of that is related to transfers. The largest which is that dark purple bar is the school funding formula transfer plus the $4 million that gets transferred over. It's about $392 million of the $430. The remainder goes to other funds through council dedications, support to the capital program, and that expenditure is shown, that transfer of revenue is shown as expenditure in the fund. So if you take those out, what you're left with is a general fund that's really only $579 million to support your ongoing basic government services, police, fire, libraries, finance. The E911 system is relying on a much smaller base to make reductions from. The other assumption that's embedded on the city side of the forecast is a change to the way we do the capital program in the forecast. In the past, we've always tied it back to the approved CIP for the city. What we know is that the use of debt in the CIP has been held back in the out years. But what we know is that as each of those out years gets closer to actually getting real funding, we're funding $108 million, city and school combined, in debt service. $108 million in debt. 32 million of that is related to the schools. So we've assumed that we're going to do in the forecast what we've always done in practice. Obviously, we can certainly tighten our belts on the CIP, curtail the projects that are out there on the city side. That hasn't been where we wanted to go as a community, but we could, and that would reduce the use of debt service in the forecast. The big drivers, I think, for city and school are and continue to be health insurance and the VRS rates. VRS is less of a concern for the city. Basically, the forecast assumes every biennium there'll be a 2% increase. That's been our pattern for a long period of time, a little high, a little low on different places. So the forecast assumes in 2017 there will be a 2% rate increase, but it's offset by a 1% reduction in our employer rate because the employees are picking that up. So it's a 1% in 17, a full 2% in 18 because you don't have another 1% drop in the employer rate because of the employee picking it up, and then a full 2% in 19. And you can see what that does to our cost structure. We've tried to factor in changes from Plan 1 to Plan 2 to hybrid, but the hybrid folks are fairly new to our system, so we don't have a big impact from them. Health insurance, you can see between 14 and 15, the changes that y'all made last year to health insurance lowered the base. But after that, we're expecting an 8% increase in medical trend. So this would have been $4 million higher all the way across if we hadn't made those changes to the health care premiums and contributions last year. Looking at the school operating fund, they don't do a lot of transfers out, so I don't have any cool little bars to disappear over here. What you can see is that payroll for the school system is about 82% of its operating fund. So anytime they're looking at reductions, they end up looking at people, class size increases, and those type of activities. Like the city, the school system, we're anticipating increases for VRS and for the employee portion switching over in 16 and 17. Remember, no other pay increases are assumed for either the city or the school system other than those. Debt service for the schools is based on the school's approved CIP. You've been getting about $32 million every year. That's what this debt service is based on, and assuming that it would continue. It does not include any changes to the modernization program, and we'll talk about that in a minute, but these numbers are based on current practice and process. Like the city, VRS and health insurance continue to be a driving factor in our budget. The employer's health insurance grows by 8% based on medical trend and usage. The VRS rate for the schools has the same assumption that the city's using. Now, I say that with a big caveat because during the recession, the state artificially reduced the VRS rate contribution for the school system. They promised to try to make that up. So we would expect an increase in 16 for the school system, but with the state budget, I don't know how far they'll go with that. I don't think anybody's heard that yet. So for right now, we're assuming the rate is the same as it was in 15, and there would be a bump in 17. So what did all that mean in terms of revenues versus expenditures? For the city, our deficit situation over the next 5 years should hover in the $15 million range. Not great, but we faced a lot worse going forward. This deficit, again, has none of the project-related, arena, light rail, anything else embedded in it. It's straight up what we do today, carried out over 5 years. The policies that we have in place today, carried out over 5 years. No rate increases are assumed to offset this. For the school system, big change was the change in the assumption about using reversion funding. And the loss of $4 million in federal revenue. If the school board were to decide to go ahead and use reversion funding and all of the Sandbridge funding, you can offset your deficit, which is $28.4 million in the first year, by about $15.6 million. If the federal government does not lower impact aid to the school system, that would be another $4 million off your deficit, getting it down to about $9 million, which I think would be the best we've seen in a few years for the school system. I'm concerned that there's a structural problem here. I think using reversion funds long-term is a problem. They've been declining each year. You're kind of squeezing your operating to fund next year's budget, and long-term, you have kind of hollowed out your service delivery issue. So that and the next thing I want to talk about are pay raises are the two big issues that I would want to leave with the council. Those are assumptions I do not think are sustainable going forward. This is a 10-year history of salary increases for the city and school system. You can see the VRS required in the first column. We did 1% the first year, 1.34, 1.34, and we'll do 2 more years of 1.34. Same thing for the schools. City gives general increase, think of it as kind of a cost of living, although we've never really tied it to the inflation rate. You can see that's been spotty as we went through the recession. We used to give merit increases, an increase based on an improved performance. One thing we want to incent in our employees is outstanding performance. The other thing the merit increase does is provide a separation between new hires and people who have been here a year or 2 years, because you're not eligible for a merit increase your first year, not until your second year. So that would separate. When we're dealing with compression issues, part of the reason we have them is because we're not doing merit increases any longer. For the school system, they did this bonus in 2012 and a 0.5% salary increase. Again, they just were trying to make work what they could. They were able to give a salary increase of 2%, and this year, 1.66, which matches the cities over those 2 years. If we were to adjust the forecast, think back to the slides of the deficit, to provide a 2% increase in the first year, you would need to increase the city's deficit, because we don't have any money right now, $6.7 million, bringing it up from $13.5 to $20.2 million. If you wanted to give the same 2% in the school system, you would need to increase your deficit by $11.5 million, bringing it up from $28 million to $40 million. Pay raises aren't cheap. As I said, schools are 82% people, so their pay raise is a lot more than ours, but it's something that I think we're gonna be remiss if we don't figure out a strategy to deal with it going forward long term. Now I'm gonna break from tradition. We never really went out beyond the current policies and practices and rates of the city. And none of the previous discussion had included any enhancements to the school modernization program, any funding system for the infrastructure related to an arena, no funding for the city's portion of light rail cost. It's critical to understand, especially for the audience, that no decision on any of these has been made by either the city council or the school board. What we wanted to do, and I think it would be remiss if we didn't, is show you the impact of these, because most of these projects are being talked about in the next 5 years, to try to give you some sense of the impact and maybe some hope that there's ways out there to fund some of this going forward. But no decision, and this doesn't preclude or set up any decision. The projects I'm going to discuss are the infrastructure related to the arena, the city's share of light rail costs based on the state funding agreement, school modernization based on an increase to the current funding of $32 million to get it up to $60, and possible funding needs for other economic development related projects, some of which are kind of squishy right now, some of which may bring its own revenue to fund its own costs, so some of this may change as you all do end up making decisions and looking at the deals. The arena. This is not the arena itself. That's being funded by a private developer. It would be operated and financed by a private developer. This is the infrastructure to support the building. The city's portion of the projects is to ensure that municipal infrastructure surrounding the arena is sufficient to handle a facility that large. City Council received a briefing on the infrastructure required back on July 2014. If anybody's interested in seeing it, it is posted on the city's website. That identified funding needs of up to $78 million. 53 has to be done for the arena, and $25 million of other options that the council could choose to do or not do. The good news is many, many years ago, city councils of the past set up something called the TIP Fund. This fund was established using dedicated revenue streams from hotel, meals, amusement, and cigarette tax. It was used at that point to fund the hurricane protection wall, the convention center, entertainment programs at the resort area, and it has capacity to address a lot of this funding need for the arena. The table illustrates the first 5 years of a long-term analysis we've worked on. It shows the revenues in 2016, expenditures, and for the purposes of this, I've shown it balanced. Coming out of 2015, it's expected to have a fund balance of $2.6 million. There's no additional cost, so that would fall to fund balance. Moving into 17, assuming that the council makes a decision to do an arena, and we had to fund our portion of the infrastructure. You see revenues, expenses, and the decrease in expenditures is really related to some of our older debt paying off and the fact that we're buying a second year of trolley replacements out of cash. So the contribution to fund balance is $4 million. 2.6 plus 4 equals the 6.6. The first debt impact of the $53 million or $78 million that we did in this analysis is $5.9 million. So it draws fund balance down to $0.7 million. Pay for it out of fund balance. Going forward, revenues go up, expenditures go up a little bit. You see the contribution to fund balance is going to be $51 million in that year, bringing the total fund balance 1.7 plus 5.1 equals 5.8. The debt service that year, unfortunately, is $7.8 million. There is a short-term deficit through 2022 of fairly small amounts that we would need to figure out a strategy to deal with. But after 2022, the fund starts gaining capacity again and can fully handle all of its debt service. Some things that you could consider to address this would be squeezing some of the programs that are funded within the fund, entertainment programs, support for solid waste activities, those kind of things that are funded in there. You could look at a short-term tax increase of some kind, of one of the revenue streams that are in there. For example, if you wanted to use the hotel room night tax, an increase of $1, it's currently $1, so that'd be a $2 per room night tax, for 5 years would fully offset the deficit going forward. Again, there's a whole bunch of ways we could do a contribution from the general fund. Unfortunately, the general fund's kind of hurting on its own, so all of this is just a way to fund it. There are 1,000 different ways and scenarios we can try to work through, but we would really recommend that we use the capacity that exists and will exist in this fund for this project. Light rail, there's 4 endpoints, alignments, I think HRT calls them. Town Center, Rosemont Road, Oceanfront via the Norfolk and Southern Right-of-Way, Oceanfront via the Alaskan Road Corridor. They're running all the expenditure side of that. Unlike the arena, no forward-thinking council set up a fund to handle transportation costs. And so there's no ready source that I can go to and say, you can use the capacity of this fund to pay for it. It's never been assumed that ridership will offset the cost of operating and building the light rail system. The state and the city agreed to split what was an estimated cost of $310 million. Basically, the town center alignment has that cost on a 50-50 basis. The city's portion of that would be $155 million. The first debt service payment, if the project gets approved, and again, there has been no approval of any of these alignments, would be in 2016. The train cars themselves have to be advance purchased. They're on the critical path to getting the light rail line up and running. If the council decides to do it, that'd be the first thing we'd have to issue some money for. So about a $10.5 million with 2 additional authorizations coming after that. So the light rail debt service, based on that schedule of debt, 800,000 in 17, 7.4, 11.7. I think in 2021 it rises to $11.7 million and stays at that level. To cover this cost, it would require some kind of a revenue source to do this, because as I said, ridership revenues, which is this is the operating cost net of ridership revenue, is not sufficient to even cover its own operating cost. Using the real estate tax rate as an example, there's other rates you can consider, and those are listed in the forecast report itself. It would take 2.9 cents. We would recommend you do it in 2016, which is a little advance of when you're going to start issuing the debt, because if you start early, you can have a lower rate over the 25 years of bonds for this particular project. So you ask, what about the transit-oriented development and the potential for that long term? We do think you will get some transit-oriented development around the stations, depending on what stations you pick, has higher or less. It's a long-term strategy, though. In the short run, on the day it opens, the likelihood of having transit-oriented development enough to cover what ultimately is going to be in the $20 million range is probably not going to happen. Over 20 years, yeah. And I think that graph would ramp up as you go out over time. One thing we would suggest consideration of is using some kind of a tax increment financing district around the light rail stations to capture any development. We'd recommend about a 1-mile radius. You could certainly do quarter mile, half mile. Half mile is considered what most people would walk to a light rail station. If you did that, then you could, as the revenue did collect in the TIF, you could use it to lower the tax rate. So that's one strategy going forward as we start having conversations and that day becomes more imminent that we may want to consider. We do have some overlap issues with the CBD TIF district, and we'll have to come up with a strategy to kind of cap that and parcel it out. But I think that's all within doable ranges going forward. School modernization. Back in 1999, the school board and the city council, Mrs. Wilson was in charge of this group, put together a financing plan to really address school modernization. And it really hinged on kind of 3 things. $32 million of debt, $17 million, at the peak, $17 million of PAYGO was being provided by the school system. As the recession hit, that got drawn back into the operating budget. And state funding through a combination of state construction grants and lottery proceeds. Both of those have been pulled back from the state. The lottery proceeds now run through the state basic aid calculation. It did some elementary schools, 23 elementary schools, 2 middle schools, 1 high school, and 2 plant facilities. So it's been a very successful program, I think, in terms of the community's impact and the students' enjoyment of those facilities. The program was originally designed for elementary schools, $25 million schools. It's now trying to be used for middle schools, high schools, $100 million facilities. So the cost of the buildings, the loss of the revenue are all contributing to a really slow down of the schedule. Back in October, school staff came to talk to the city council and school board about this program and about a desire to have it ramped up. They laid out three options: a $50 million option, which adds $18 million to the program, a $60 million option, which adds about $30 million to the program, and an $80 million option, which adds about $48 million in funding. What you can see, and this is right out of their presentation, I added the current schedule that's in the CIP. You can see that for John B. Dye, it doesn't really change it. For Thorogood House, if you get up to the $60 million, it comes online a year earlier. I'm sorry. Thorogood Elementary School. Okay. Math.
They were happy to hear that.
What's the next one? Princess Anne Middle. You get a real advancement. You're at 2023. You can get it 3 years earlier. You can get Princess Anne High roughly 3 years earlier. Betty F. Williams, which isn't even funded in the current CIP, comes online. That's when it opens at 2023. And Kempsville High School doesn't really get helped a whole lot, but it would be out there in the next years probably. So when we were looking at this, we said, the school board hadn't made a decision or an official request, we'll pick the middle one. So we went for the $60 million option. If you do debt on $60 million, an additional $30 million is basically what it is. And we said we would start in 2017, 18. That's a decision that can certainly be moved around. It would be $3.2 million. An additional $30 million happens each year. So then it jumps from 3.2 to 2.6 to 9.2, 6.2. My mouth is gone. The problem is, under the current formula, that's not a city problem. That issuing that debt and the debt service on a $30 million every year forever strategy gets up to $47 million in 2037. And then stays flat, because as the older debt pays off, you can repurpose it back to keeping that $30 million strategy going forward. That doubles the school system's debt. Under the current formula, that's the first thing out of the revenue stream, the revenue sharing formula, is debt service. So if we were to decide it and we didn't make a change to the formula, then the schools would have to, it's a real cost to the school system in terms of squeezing other programs out. Remember, the school system's in deficit situation, so I don't see that as really, at least in the short term, a real viable strategy. If not, the council wanted to use a tax increase, we could certainly tweak any of the taxes within the formula. I'm using real estate because that's kind of an easy one for everybody to get their head around. You need a 4.6 cent increase in 2016. Public-private partnerships, there's several under discussion, none of which have really come to fruition enough that we could run a fiscal impact analysis on. Certainly none that the city council has committed to in a big way. They could be the dome site, additional phases of town center, parking decks, et cetera. So one of the strategies that we talked about with finance was coming up with about $102 million of additional debt that could be authorized for any of these projects. It could be $5 million to one, $20 million to another. There's no strategy here other than a lump of debt. The first authorization of that lump would be in 2017. Could we pick $29 million? It could be something different. But for the purposes of the analysis, we had to get a place to start. If you did that, starting in 2017, your first debt service payment, based on $29 million in the first year, and it grows, reaches a peak in 2020 of about $10.2 million in debt service. To fund that would take a $1.4 million or 1.4 cent increase in the real estate tax rate if the projects did not bring revenue with them that can cover their operating cost or their debt service cost. In the past, all these projects do generate some revenue, and we would encourage that to continue as a practice, and that would significantly mitigate that, or if you didn't need all that $100 million, it would also mitigate that. So the bad news, and you have to add it all up, that's part of what I do. You see the city's deficit every year, the school's deficit. Now remember, they can lower that if the federal revenue comes in or if they decide to use reversion. I think we should give some strategy to coming up with a pay increase. Doesn't have to be this amount, doesn't have to be this pattern, but at 2 a year, that's what you end up with. Debt service on all of the projects that I've talked about adds up to $8 million in 17. Most of that would have to be authorized in 16, and then the first payments would be in 17. Grows over time. Light rail operating cost. This is the operation of the train and the enhancement to the bus service that would be needed to support the train if you all decide to do it. The bus service right now, what we wouldn't want to have happen, and the reason it needs to be enhanced, is you wouldn't want to get off the light rail at Witch Duck Road at 10 o'clock and the bus quit running at 9. And that's the situation we have today in our bus service. So most of that money goes to match up the bus route times with the transit times, although it does cover the security and driver and electricity to operate the light rail. So some final thoughts. Both the city and school system are working on enhancing programs, be it process improvement, working with Mr. Dyer's process improvement committee. The school board superintendent mentioned to me the other day that he's looking to ramp up program evaluations. We're constantly looking for ways to improve efficiency, and that will help to reduce some of this deficit. We're looking for ways to share services, be it with the school system or with other cities in the region, where instead of all of us having a sign shop, Virginia Beach can have a sign shop and the other cities pay us to buy signs. So that strategy is out working. And we're looking for any other cost-cutting measures we can come up with. We can continue to tighten our belts, but I think we need to change our priorities, change some of the ways we do business and the ways we deliver the services desired by the community. But this is the 6th year of squeezing that turnip, and I'm not entirely sure how much more effort will gain you, but we do need to do it, and we need to keep focusing on that. The school's deficit without the use of reversion funds is not sustainable. We just need to come up with a different strategy. I think it would be ideal in my perfect little world if the cities and the state got together and said, we want to have a world-class school system as the state of Virginia, and we're going to figure out a way to get there. I pulled some statistics before I came down here. For local revenues to support K through 12, this is for 2013, Virginia ranks 13 among all 50 states. For state revenues to support K through 12, Virginia ranks 41st. So localities are stepping up, but it's a system that we have to work together. And I think if we can figure out a way to work with our delegation to further that conversation, we ought to have that strategy going forward. The projects that I've discussed here have the potential to change the city's economy. One of the things we always want to be doing is figuring out ways to grow our economy, benefit our citizens, find jobs for the kids coming out of high school and college. These projects have that potential to do some of that. And ideally, they would generate excess funds to help reduce deficits. In the past, it was always the council's policy to only consider major projects when they had a revenue source. As I mentioned with the TIP fund, it was originally done for the hurricane protection wall. Taxes were raised to do that. When we did the convention center, council stepped up and we did taxes again. But it doesn't matter. If it's private developer revenue, if it's the revenue from the activities of the facility itself, those things need to be captured and pooled to help support the city's cost of that. What we're advocating is basically try to return to that policy as much as we can. Any tax adjustment, I know, is hard, and it must be made in the context of our overall economy. Families are doing a little better. The economy is doing a little better, but none of it's back where it was in 2004, 5, 6. And I think we need to be conscious of that as we talk about financing policies going forward. That's all I had.
Catherine, we thank you. You kept it right on time, I might add.
Oh.
Council and school board, again, we have a situation that doesn't look real pretty at first, but as we have in the past, we will figure it out. Now, I would also, before we conclude, I would just say that, you know, both bodies have to sit down here in the upcoming months to really strategize on finding a long-term financing solution, in my opinion. Yes, John?
Mayor, I recognize that the staff's consumed all the time, so there's no time for public discussion, but I hope we could reconvene as this body with the staff watching, because I don't want the public to walk away and thinking this is an objective analysis of where we are, because it's not. And this is all they're hearing, and there is more to be said than what we're hearing here. And that needs to be discussed among all of us so we can come to a grasp. This is one perception, but is by no means accurate.
Okay, and we'll follow up accordingly, Mr. Moss. Beverly?
One of the things that she suggested was that we lobby together, but the next time we talk about this, I would love to invite our legislators, our local legislators, to attend this as well and be informed as we are informed.
Very good.
Thank you.
All right, well, to keep us on schedule, folks, we both have meetings at 4 o'clock, so we'll adjourn, and thank you all for attending.